Good morning. Welcome to Unit 10, Retirement. So our first classwork has to do with retirement income from savings. So how can you save for retirement? There's a specific point in a person's life when he or she stops working. This is called retirement. You can be semi-retired. That is, you can continue to work at a part-time job or wherever as a financial necessity. But many people begin planning for their retirement at an early age. In fact, your first job, you will be offered the opportunity to start planning for your retirement. So some retirement accounts are made with pre-tax dollars, and we talked about that when we did the tax section. A pre-tax investment is a deposit made to a retirement account that's taxable out of your wages before taxes have been, or taken out of your wages before taxes have been calculated and deducted. Pre-tax investments lower your current taxable income, which is good. Other types of accounts are made with after-tax investments. That is, this money is deducted from your income after your taxes have already been deducted. So I'm going to skip that. You can read this section on your own. Make sure you're aware of some of the vocabulary. But let's jump into example 1. And if you see example 1, below it is the formula for the future value of a periodic deposit investment. I went ahead in your OneNote pages and put future value, present value, and a note sheet on all the formulas for compounded interest and future value and present value. So those formulas and those Excel calculators are already in there. Example 1, Blythe is 40 years old. She's planning on retiring in 25 years. She's opened an IRA with an APR of 1.25% compounded monthly if she makes monthly deposits of $500 to the account. How much will she have in the account when she's ready to retire? So go ahead, open up that calculator if you can't find your own for future value of a periodic deposit. When you plug in the numbers, you should get 175, 975, 51. Which would have a greater effect on the final balance in Blythe's account? If she only made half the monthly deposit, or if the interest was cut in half for those years. So because she's depositing $500, half of that would be $250. So plugging that in to our future value calculator, the future value should show she would have $87,987.76 when she's ready to retire. If she did half the interest, we're looking at an interest rate of 0.625%. That would give her a future value that equals 162,308.06. Now, if you're struggling to get that number or your calculator's not working, make sure when you plug in the interest that you put in this 0. So it's 0.625. So paying less per month, you can see, has a greater effect than half the interest rate in this situation. Suppose Blythe's annual contribution was pre-tax. So suppose that $500 per month was pre-tax. How much would she save in taxes in 1 year if her taxable income for that year was $72,500. So she's put the money away pre-tax, and her taxes for the year is $72,500. Well, we go to the tax table, and this is the 2019. This isn't the one from the book. We go down, 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 and we see right here. So Blythe filing single, her taxes she's going to owe $11,825 or eight. Oh, I highlighted the wrong. Sorry. Should be this line. 11,814. $11,814 in taxes. So $500 a month for 12 months. 500 per month. For 12 months. That's $6,000 that she contributed pre-tax. So her income has been reduced by that $6,000. But if her retirement, so it says, how much would she save if her taxable income for that year was $72,500, and that was pre-tax? What if it was post-tax? That means her retirement deductions not. We're going to add that $6,000 to the $72,500. So that means $72,500 plus the $6,000. She would be paying taxes of $78,500. $78,500. That means if it was post-tax, she'd be paying taxes of $13,134. So contributing pre-tax, that difference is $1,320 that she saved in taxes by contributing pre-tax rather than post-tax. Chelsea is 45 years old. She plans to open an IRA. She wants to have $300,000 in the account when she retires at age 62. So how much must she deposit each month? So remember, when you are using a periodic deposit, you either put it in as a single deposit and leave it alone, or you might have periodic deposits. So in this case, she's got a periodic deposit each month. So we're going to use the present value calculator. So check that your calculator or mine works, but we need to know how many years. So 62 minus 45, that's going to be 17 years. And since she's making periodic deposits, we want to know how much each month she should be saving. She needs to deposit $1,330.04 each month. At 1.1% if she hopes to have $300,000 in the account when she retires. Davin's 35 years old. He plans to open an IRA. He wants to have $500,000, $500,000 in the account when he retires at age 60. So we're looking at 25 years. Of saving. How much must he deposit each month into an account if the annual percentage rate is 1.6% if he wants to reach that goal. So double check your calculator. That's going to be $1,356.60, which would result in the need for a larger monthly deposit. In this case, half the interest rate for Davin or half the number of years before the money is withdrawn. So we're either looking at half of 1.6 is 0.8%, 0.8%, or if it's 12 years, we're looking at, or 25 years, we're looking at 12.5 years. All things being equal, at 0.8%, he's depositing, his present value would be $1,506.10 per month. Or if he's only going for half the time, present value, $3,013.32 per month. So clearly, half the time is going to have a bigger impact. Example 4. Xander is a 50-year-old married man who filed taxes separately from his wife. He's been making monthly contributions into his traditional IRA for many years. Making contributions to an IRA is after tax. Last year, he entered into a new business partnership and decided to withdraw $50,000 from his IRA to make the initial investment in the partnership. Xander's taxable income for the year, excluding the $50,000 from his IRA, was $96,000. So how much extra did he pay in both penalty and taxes because of this early withdrawal? So let's look at that. $96,000. His tax is $17,221. With the withdrawal, that's that $96,000 plus the $50,000 is going to be $146,000. So before the withdrawal, his taxes would be $17,221. Now that he's taking an additional $50,000, that bumps his income up to $146,000. So we're going to have to use the federal tax rate schedule. And in the federal tax rate schedule, he is here. Remember, this is a piecewise function. So his tax now is, what is that, $14,382 plus in the 24% tax bracket, it's $146, and that's minus $84,200. So that means his tax is $29,214. Plus there's a penalty. There's a 10% penalty from the IRS for early withdrawal. if it's before 59.5. So 10% of that 50,000 is 5,000. So how much did he pay in taxes that year? At 29,214 plus the 5,000 penalty minus 17,221. If he'd never taken the money out, extra is 16,993. That's a lot, just for taking out that 50,000. Employer matching programs. Some employers offer 401k retirement plans in which they match the employee's contribution up to a fixed amount of the salary one makes. This is extremely beneficial to the employee and is an excellent employee benefit. The money contributed by both the employer and the employee earns interest and is tax deferred. So most companies only allow employee contributions to the 401k plan up to a certain percentage of the salary earned based on government rules. There's also a maximum allowable contribution, which may change each year. Employer matching contribution is not calculated into the 401k yearly contribution limit. Here we go. Leo makes $75,000 per year. His company is offering a 401k retirement plan in which they match 50% of his contributions to the 401k up to 6% of his salary. The company allows employees to make contributions to a maximum of 15% of their salary based on contribution rules that pertain to their particular financial organization. Because Leo is younger than 50, his maximum contribution to his 401k is a total of $18,000. So how much should Leo contribute per month in order to maximize his employer's maximum contribution? Well, he can do up to 15,000, or 15%. 15% of that 75,000 pre-tax, he can put in $11,250. Monthly, that's going to be $937.50 per month. But it says he wants to, in order to maximize his employer's matching contribution. Suppose Leo just wants to contribute an amount up to his employer's matching. All right, so let's go back and look. 6% of his salary. So instead of the maximum that Leo can contribute, if he just wants to do what the employer is going to match, 6% of the 75,000 is 4,500 or $375 per month. His employer is going to match half that. So 3%. Well, that's half that, 2,250 divided by 12. So his employer is going to put in $187.50 per month. So if he just wants to maximize, he's getting, by just putting in 6%, $562.50 per month with the match, or $6,750 per year.